Ready to unlock some market secrets?
I think we have got some good ones today.
Well, let's find out. Today's deep dive is going to be into Inside Advantage.
Oh, this is going to be good.
Yeah, this is a collection of excerpts, from a financial newsletter spanning a bunch of years, and we're going to be looking for all sorts of insights.
Yeah, I think people are really going to like this. There's something in here for everybody.
I think so, too. From, seasonal patterns, in commodities.
To the minds of some legendary traders.
Oh, yeah, and how they think.
This is really, I think, a blend of quantitative and qualitative analysis.
Yeah, we got numbers.
We got psychology.
We got it all. So get ready, everybody. Inside Advantage really dives into the importance of seasonal patterns.
Especially in commodities trading.
Have you ever heard that saying, sell in May and go away?
Ah, yes, the old Wall Street adage.
Yeah.
There's actually a lot more to seasonal trading than that. And understanding the nuances can really give you an edge.
Okay, so more than just sell in May and go away.
Right. These excerpts talk about carrying charges and how those affect seasonal pricing.
Carrying charges. Okay, I'm not familiar with that. What are those?
Okay, so think about storing grain, physical commodities like grain. You've got warehouse fees.
Oh, right.
You got insurance costs. Even the interest on the money that you use to buy that commodity.
Ah, I see.
Those are carrying charges. And they get factored into the price, especially as we approach harvest season.
Okay, so as we get closer to harvest time, the carrying charges get higher. So I guess it makes it more expensive to hold on to it. So does that mean that prices tend to fall before harvest?
Exactly. Unless there is some supply shortage on the horizon. Maybe a bad weather season or a disease outbreak, something like that.
Oh, right.
Some geopolitical event, who knows?
So like corn and wheat, that kind of stuff.
Yeah, corn and wheat. Prices on that stuff will often drop as those carrying charges peak.
So if you're thinking of like stocking up on corn and wheat and all that, you should probably wait till right before harvest, maybe.
It could be. But here's the key takeaway. Always look for a valid explanation for a seasonal tendency. You don't just want to blindly follow historical patterns.
Okay, don't just follow it because it happened before. Gotcha.
Right.
Okay, so Inside Advantage highlights how grain prices often rally after harvest, even though there is like way more supply.
Right.
I don't understand that.
It seems counterintuitive.
Why would it go up?
You would think prices would go down.
Yeah.
But even though there is more grain available, those storage costs are still there.
Oh, right.
And demand for consumption usually increases after harvest.
Oh, okay.
That's why you see those post-harvest rallies.
Okay, so it's just because everyone wants it?
Yeah, increased demand.
Got it. Okay, so Inside Advantage also points out that there are different methods of seasonal analysis.
You can look at it monthly. You can even look at it weekly. And each has its own pros and cons. It just depends on your style of trading.
Yeah, that's a great point, I think, about having different approaches. So I guess just because something has happened seasonally in the past doesn't mean it's guaranteed to happen again.
You got it. You need to have more than just the historical precedent. You need to see some statistical reliability. You want to see consistent profits when you're evaluating a seasonal trade.
It makes sense. All right, so now Inside Advantage doesn't just stop at seasonal trends within a single market.
They also explore how different markets influence each other.
Right. It's all, I think they called it intermarket relationships or something.
Right. Think of it like a giant spider web, right?
Right.
You tug on one strand, the whole thing vibrates.
Whoa.
Markets are interconnected in some fascinating ways, and understanding those connections, that can really provide some insight.
And I know they reveal some surprising connections in here.
Yeah, like the idea that the stock market is actually a leading indicator of economic activity.
Oh, wow.
That kind of goes against conventional wisdom, doesn't it?
It really does, yeah.
Many people assume that stock prices just reflect the current economy.
Yeah.
But Inside Advantage argues that stock prices actually anticipate future economic trends.
Wow, okay.
It's controversial,
So they're going out on a limb here a little bit.
but I think they make a pretty compelling case.
I never thought about it like that. That the stock market could actually predict the economy. I don't know, that's a game changer.
It really changes how you might interpret market movements, I think. Another intermarket relationship is the one between stocks and bonds.
Yeah, and most people say that they move in the same direction, but this newsletter says that they can decouple under certain circumstances.
Right.
Okay, so when would that happen?
Well, one example they give is during periods of runaway bull markets,
Ah,
when
okay.
the stock prices are just skyrocketing while bond yields stay flat or even decline. Think back to the late 1990s, the dot-com bubble. The S&P 500 was just soaring, but bond yields were actually falling.
Hmm.
That's a prime example of decoupling driven by excessive optimism.
Okay, so everyone was just so optimistic about the dot-coms that it skewed everything.
That's what they're arguing.
Okay, so it seems like understanding these intermarket relationships can really help you to understand the whole economic picture. Like you're saying, it's another piece of the puzzle.
Absolutely. Helps you anticipate potential shifts and turns in the market. And speaking of those, inside advantage also goes into the causes of market crashes.
Oh, okay.
And they don't shy away from challenging the traditional narrative.
You mean like everyone thinks of like 1929, right?
Yeah.
All the speculation.
Right.
Everyone was speculating.
Well, they dig deeper. They say that the Federal Reserve's attempts to actually control the speculation by raising interest rates actually made things worse.
Wait, so they tried to cool down the market and it backfired.
They raised interest rates, which made it more expensive for businesses to borrow money, which slowed economic growth.
Oh, right.
And that contributed to the severity of the crash.
Wow, so it wasn't just the speculation, it was also the Fed trying to step in.
That's what they're saying.
So then what was the real villain of the story?
Deflation. That rapid decline in prices following the crash that led to widespread corporate losses and bankruptcies.
Oh, wow, okay.
They don't just focus on 1929, though. They compare and contrast it with other historical crashes, each with its own unique set of triggers and consequences.
Oh, interesting.
They talk about 1987.
Oh, okay.
That crash, that was driven by fears of inflation. And then 1962, that was triggered by the Cuban Missile Crisis.
Oh, wow. Okay, so different things going on.
Each one a little different. But fear and uncertainty are the common threads.
Yeah, that makes sense. Whether it's fear of inflation or war, economic collapse, it seems like, those emotions can drive investors to make irrational decisions.
It leads to cascading sell-offs.
Right, and then market panics.
Understanding the psychology behind these events, that's just as important as analyzing the economic fundamentals.
So you have to get inside their heads a little bit.
You have to understand why they're doing what they're doing.
Right, because if everyone's panicking, there must be a reason. All right, well, Inside Advantage also dives into the human element of trading.
It talks about matching your trading style to your personality.
Oh, okay, interesting. So they're saying it's not just about finding like a system that works.
It's got to work for you.
It's going to work for you. So Inside Advantage describes these different trader personality types, each with its own strengths and weaknesses. There's the upstairs trader, right?
Who's very analytical,
Yeah.
comfortable with those longer time frames.
Okay. And then there's the downstairs, or the floor trader, they call them.
They thrive on fast-paced action. Need that instant gratification.
So that would not be me.
You have to know yourself before you even think about placing a trade. Self-awareness can help you choose a trading methodology that aligns with your natural tendencies and your risk tolerance.
Okay, I like that. That's a good point. All right, and that leads us to another critical aspect that Inside Advantage stresses, and that's money management. They're adamant about this, right? Even for traders with profitable systems.
Oh, they should be, because that's where so many traders go wrong, even the ones with the winning strategies.
So they're making money, and then what?
They fail to manage their risk effectively,
Ah, okay.
and then they get wiped out
Oh, no.
by those inevitable losing streaks. Inside Advantage says that even if your system wins most of the time, if you don't manage your risk properly, you can still lose everything.
Oh, wow. That's scary. Okay, so what kind of money management strategies are they talking about in here?
Well, one of the things they challenge is the idea that you should always risk a fixed percentage of your account on each trade.
Really? Yeah, I've heard that before.
Yeah, like 2%.
Like 2% or 3%. You always hear only risk what you can afford to lose. What's wrong with that?
While the idea is sound, rigidly applying a fixed percentage can lead to dangerously high risk,
Okay.
especially when markets are volatile or you're using wider stop-loss orders. Imagine if your account is small, you suffer a string of losses, that fixed percentage could wipe you out quickly. So what do they advocate for? They advocate for what's called the fixed ratio method,
Okay.
which scales your position size based on your account balance and your system's historical drawdown.
Okay, before we go any further, can you remind me what drawdown is again?
Yeah, drawdown is the peak to trough decline during a specific period for an investment or a fund or trading account. Let's say your account hits a new high of, let's just say, $100,000.
Okay.
Then it drops to $90,000.
Right.
you've experienced a $10,000 drawdown. The fixed ratio method takes this into account.
Okay, so how does the drawdown play into this fixed ratio method?
It's all about calculating what they call the delta, which is a fraction of your system's historical maximum drawdown. Basically, the biggest loss the system's ever experienced. So let's say, again, your system's maximum historical drawdown was $10,000.
Okay.
Your delta might be $5,000 or even $2,500.
Okay.
Depends on your risk tolerance.
Oh, right, of course.
And that delta determines how many contracts or shares you trade.
Ah, I see. Okay, so as your account grows, you add contracts in proportion to the delta.
Exactly.
Okay.
So if your delta is $5,000 and your account grows by another $5,000, you'd add one more contract.
Right.
If your account drops by $5,000, you reduce your position by one contract.
Okay, so it's kind of like more responsive to changes in my account balance.
Exactly.
So how does that help during a losing streak?
That's the beauty of the fixed ratio method. As your account shrinks during a losing streak, you're automatically reducing your position size. It prevents those devastating losses that can wipe out years of gains.
This sounds like a much safer and more responsive approach to money management than just like sticking to a fixed percentage no matter what's happening, in the market or with my account.
Exactly. The fixed ratio lets you ride out those inevitable losing streaks and then ramp up your position size when your system is performing well.
Makes sense. Inside Advantage also spends a lot of time discussing trend-following strategies.
Especially the legendary turtle traders.
Yes, I've
Yeah.
heard of them, yeah.
The turtle traders were a group of novice traders trained by two legendary commodity traders, Richard Dennis and William Eckhart.
Okay.
They were given a simple set of rules based on breakouts from price channels, and they achieved remarkable success.
Wait, are you saying they just took a bunch of newbies, gave them a system, and they were just like superstars?
They proved you don't need to be a financial genius to make money in the markets.
Wow.
What you need is discipline, consistency, and proper money management.
Of course, there it is again. Okay, so how did their system work? How did the turtles do it?
The core of the system is a channel breakout strategy.
Okay.
You buy when the price breaks above a 20-day high, sell when it breaks below a 20-day low.
Okay.
They also had a 10-day exit rule to protect profits and manage risk.
Oh, okay. So they're catching those big sustained moves while minimizing losses during those choppy periods.
That's the essence of trend following.
Oh.
And Inside Advantage points out that when done right, trend following systems can be incredibly powerful and enduring strategies for long-term trading success.
Okay, so trend following can work, but you gotta do it right.
Yeah, and they caution against just blindly following the rules.
Right.
I
Okay.
have to understand the system's strengths and weaknesses, be able to adapt to changing market conditions, understand when the system just isn't working.
Okay.
It's what they call the care and feeding of a turtle system. You need to constantly monitor its performance, adjust your position sizing based on your risk tolerance and account balance, and be prepared to modify the system's parameters.
Wow, that is a lot.
It is.
This is a lot of information to absorb.
It is, and we're just getting started.
Yeah, I think we need to take a pause here, everyone. Let all this information sink in a little bit. We'll be back in a moment to continue our deep dive into Inside Advantage.
See you in a bit. Welcome back. I'm really excited to delve into some of these fascinating trader profiles that are featured in Inside Advantage.
Yeah.
I think each one offers such a unique perspective on navigating the markets.
Yeah, that's cool. And it just reinforces this idea that, there is no one-size-fits-all approach to trading.
It's all about finding what works for you.
What works for you, exactly. You mentioned earlier the importance of, matching your trading style to your personality. And I know Inside Advantage has a great interview with Linda Raschke in here. She started as a floor trader, right?
That's right. She spent years on the Chicago Mercantile Exchange floor, gave her an incredible feel for market dynamics. She's known for being a very skilled and intuitive trader.
What struck me about her interview was she doesn't totally dismiss mechanical systems.
Right.
She kind of uses them as tools to help her make decisions, but she also relies heavily on her own judgment and experience.
That's a really important point. Even traders who use systematic approaches often incorporate elements of discretion into their trading.
Yeah.
It's all about finding the right balance between following the rules and adapting to, the constantly shifting market landscape.
Yeah, nothing stays the same, right?
You got to be able to change with the market.
Exactly. She also talks about how floor traders could gain an edge by understanding the trading patterns of the specialists.
Right.
Now, can you explain what specialists do?
Yeah, specialists acted as market makers.
Okay.
They were responsible for maintaining orderly trading in specific stocks.
Oh, all right.
They had access to information about, like, order flow and market depth that other traders didn't have. Linda Raschke noticed that some specialists used different trading patterns depending on the size of the order they were trying to fill.
Oh, so by studying the specialists' patterns, floor traders could kind of anticipate how they might react to a large order.
And then adjust their own trading accordingly.
Oh, that's pretty clever.
It's all about recognizing those subtle cues and signals that reveal the intentions of other market participants.
Oh, that's so interesting.
It's like playing poker, where you try to read your opponent.
I like that. Yeah, read your opponent. She also emphasizes starting small and gradually scaling up your position size as you gain experience and build your account.
Right.
Which makes sense, right?
Absolutely. It's a principle echoed by many successful traders. It's all about managing risk, protecting your capital, and avoiding those big losses that can set you back, psychologically and financially. She specifically recommends that traders with accounts, say under $25,000, stick to trading a single contract, even in those liquid markets like T-bonds and gold.
Wow, that seems really conservative.
It is.
Why such a small position?
Well, it's a lesson in risk management and capital preservation. By keeping your leverage low, you can weather those inevitable losing streaks and stay in the game long enough to let your winning trades compound.
Okay, I like that. I love that advice about starting each trading year by making small, scrappy trades, as she called them, to get ahead a little bit, and then gradually taking more risks with, quote, the house's money.
It's a great way to build confidence and momentum without putting your initial capital at too much risk. It's a testament to the power of compounding.
Right. Small gains can lead to significant profits over time.
Right.
Inside Advantage also features an interview with Larry Williams. He's, a legend in the trading world.
Oh, yeah, Larry Williams.
Known for turning small accounts into, massive sums of money. Didn't he win a trading championship or something?
Absolutely. Larry Williams is a true iconoclast.
Wow.
He won the Robbins World Cup Championship of Futures Trading back in 1987. He turned $10,000 into over $1 million in just 12 months.
$1 million.
Yeah.
That is incredible. No wonder he is considered one of the greatest traders of all time. What sets him apart? What's his secret sauce?
Well, one thing is his focus on finding systems based on a reasonable premise. He's not just looking for patterns in the data. He's looking for the underlying logic that explains why those patterns exist.
So he's not just chasing patterns. He's trying to understand, the reasons behind them.
He wants to understand cause and effect,
Okay.
not just follow statistical signals blindly. And he's a big proponent of thoroughly testing those systems.
Oh, okay.
To make sure they're not just curve-fitting the data.
Right.
That means testing, what they call in-sample and out-of-sample.
Okay. Can you explain the difference between those two types of testing?
Sure. So in-sample testing is evaluating a system's performance on the historical data that it was developed on.
Okay.
Out-of-sample testing uses a completely different set of data
Gotcha.
to see how well the system generalizes to new market conditions.
Oh, okay. So you want to make sure that the system isn't just a fluke, right?
Exactly. It has to be robust enough to work in different market environments.
Gotcha. Larry Williams also stresses the importance of not being afraid to, modify and improve your systems over time.
As market conditions change and new data becomes available,
Right.
he sees system development as a continuous process of learning and refinement.
Okay, so you never stop learning.
Never stop learning. Now, I know you're interested in hearing about his insights on money management.
Yes.
He is not a fan of the fixed percentage approach.
Right. I read that.
He argues that it can lead to taking on too much risk when your account is small.
Okay.
He advocates for a more aggressive approach,
Yeah.
especially when you're starting out. The idea is to focus on rapidly growing your account, taking calculated risks, and then dialing back the leverage as your capital base expands.
So rather than playing it safe, he encourages newer traders to be more aggressive to build their capital more quickly.
Yeah. He uses the analogy of recapitalizing your account, treating trading profits as new capital to be deployed strategically.
Okay.
It's a mindset shift, viewing your trading account as a business and reinvesting profits to fuel further growth.
Okay. I have to admit, though, some of his money management techniques seem a little extreme.
It's important to remember that Larry Williams is a seasoned trader with a high risk tolerance.
Yeah, of course. Yeah.
What we can take away from him is the power of compounding and the importance of taking calculated risks to grow your account. It's about finding that balance between risk and reward.
Risk and reward. That's it. The next trader profiled in Inside Advantage is someone I think you are familiar with. John Murphy, the technical analyst who was on CNBC, for like 20 years? Something like that?
John Murphy, true pioneer in the field of intermarket analysis.
Yeah, he was there forever.
His book, Intermarket Technical Analysis, is a classic.
It is. And what stood out to me from his interview was this emphasis on understanding the relationships between different asset classes, stocks, bonds, commodities, currencies. He sees them as interconnected, right?
Right.
So by analyzing their relative strength and weakness, you can get valuable insight into the overall market direction.
That's the essence of intermarket analysis, seeing the markets as a complex, interconnected system. Murphy believes that you miss a lot of valuable information if you just focus on one asset class.
Right.
You got to look at the whole thing.
The whole picture. He even makes this case for using intermarket analysis to forecast economic trends, even claiming that it's more accurate than traditional economic indicators.
Wow.
Is that possible?
He thinks so.
Okay.
He believes that by analyzing the relationships between stocks, bonds, and commodities, you can get a read on investor sentiment and economic expectations, which can often predict future economic trends.
Wow. So by looking at how different markets are interacting, you can get clues into what the economy might do down the road. Like, what would be an example of that?
He mentions an instance where he correctly predicted that the economy was going to be stronger than economists were expecting, simply by observing the rotations within the stock market.
Interesting.
Different sectors were performing well. He was able to kind of connect the dots.
So he saw clues in how money was moving between sectors and correctly anticipated the economy's direction. That's a real testament to intermarket analysis.
It really highlights the interconnected nature of the markets.
You got it. He also shares some insights into the correlation between stock markets in different countries.
Yes.
Which I thought was interesting.
He points out that markets like Japan and Germany often have a positive correlation with the U.S. dollar.
Oh.
This means they tend to move in the same direction as the dollar.
So if the dollar strengthens, you might expect to see stocks in Japan and Germany rally as well.
Yeah, that's the general tendency, yes. But he cautions that correlations can change over time.
Oh, right, of course.
It's important to constantly monitor those relationships and adjust your trading strategies.
Right. Okay, so it's a powerful tool, but it's not perfect. You got to stay on top of it.
That's right. Inside Advantage also includes an interview with George Lane, the father of stochastics.
The father of stochastics. What are stochastics?
Well, George Lane developed the stochastic oscillator, a widely used technical indicator that helps traders identify overbought and oversold conditions.
Okay.
It's a momentum indicator. It compares a stock's closing price to its price range over a given period.
So it can tell you when a stock might be getting too stretched in one direction or the other.
Exactly. And what I found insightful about his interview was his emphasis on the importance of having a clear trading plan and sticking to it, even when things get tough. He has a great quote. He says, "The difference between making money and failing in commodities is controlling the size of your losses."
That's good. Okay, so that all comes back to like discipline and risk management.
Absolutely. He also talks about the importance of finding the right entry and exit points for your trades,
Okay.
using a combination of technical indicators, price patterns, and volume analysis.
So it's not just about jumping into a trade, it's about carefully considering those entry and exit points.
It's about finding confluence.
Yeah.
Multiple signals that align to confirm a trading opportunity. Lane also shares some great stories about his early days as a trader back in the 1950s.
Oh, wow. Okay.
When technical analysis was still in its infancy. He talks about how he and his fellow traders would actually sneak onto the University of Michigan computers to test their trading ideas. They discovered the formula for the stochastic oscillator almost by accident.
You're kidding. Wow. So they were like, I don't know, like computer hackers back in the day.
Yeah, kind of, yeah.
That's great. It's a great reminder that innovation often comes from unexpected places.
Yeah.
And that, persistence and a willingness to experiment can lead to these groundbreaking discoveries.
Right. Inside Advantage also features articles on the psychology of trading, including a fascinating piece by Adrienne Loris Togaray. She's a trading coach who helps traders identify their strengths and weaknesses and develop a personalized trading plan.
Okay, cool.
She emphasizes finding a trading style that aligns with your personality and risk tolerance.
Right. It all comes back to knowing yourself, right?
She describes different trader personality types like the analytical and patient upstairs trader
Right.
and the instinctual, fast-paced downstairs or floor trader.
I remember that, yeah. I like those little descriptions. She also talks about, like, Managing your emotions and setting realistic expectations.
Yeah.
And developing rules and routines to stay disciplined and focused, especially, if you're trading from home.
Right.
A lot of people are doing that now. You need to create a trading environment that supports your success, both psychologically and logistically.
Your emotional state and your physical space can dramatically impact your trading.
It really can, I think. It seems like this Inside Advantage newsletter has covered so much.
We've explored seasonal patterns, intermarket relationships, market crashes, trading psychology. We even got a glimpse into the minds of some legendary traders.
It's true. It's like a whole education.
It is.
In trading, really. But there's one more piece I think that we need to discuss a little more.
Oh, yeah.
Money management.
Yeah. The art and science of preserving capital and maximizing profits. Inside Advantage keeps returning to this topic, stressing its importance for traders of all levels.
And I remember one article where they kind of break down some common money management mistakes and offer some insightful alternatives.
Yeah. They challenge the common belief that you should always risk a fixed percentage of your account on each trade.
Yeah, that's the classic advice, right? Risk 2% or 3% of your capital on every trade.
Right. While the principle of only risking what you can afford to lose is valid, rigidly sticking to a fixed percentage can lead to taking on too much risk.
Yeah.
Especially when your account is small.
Okay.
Or the market is volatile.
So what do they suggest instead of a fixed percentage?
A more dynamic approach.
Okay.
One that adjusts your position size based on your account balance and the system's historical drawdown.
Can you remind me how that works again? I know we touched upon it earlier, but just to make sure.
Sure. So you calculate what's called a delta, which is a fraction of your system's historical maximum drawdown, the biggest loss the system has ever experienced. So, for example, if your system's historical maximum drawdown was, say, $10,000, your delta might be $5,000, maybe even $2,500, depending on your risk tolerance.
Oh, right.
And you use that delta to determine how many contracts or shares you trade.
Ah, okay. As your account grows, you increase your position size proportionally to that delta.
You got it. So if your delta is $5,000 and your account grows by another $5,000, you would add one more contract. If your account drops by $5,000, you reduce your position by one contract.
That definitely seems like a more responsive and risk-aware approach than just sticking to a fixed percentage no matter what's happening, in the market or my account.
Right. It's about protecting your capital, managing risk, and staying in the game long enough to let your winning trades compound.
Yeah, it's a much more adaptable strategy, isn't it?
Absolutely. Now, Inside Advantage also delves into the world of trend-following systems,
Right.
Highlighting those legendary turtle traders.
The turtles, I love those guys.
And their simple but very effective channel breakout strategy.
Oh, yeah. Can you refresh my memory on how that system works?
Sure. The core of the system is a channel breakout strategy.
Okay.
You buy when the price breaks above a 20-day high, sell when it breaks below a 20-day low.
Okay.
And they had a 10-day exit rule to protect profits and manage risk.
So basically looking to ride those big sustained moves and avoid those choppy sideways markets.
Yeah, that's the essence of trend following.
Okay.
And Inside Advantage points out that when done right, these trend following systems can be very powerful and enduring strategies.
But again, they caution against just blindly following the rules.
Of course.
You can't just set it and forget it.
Understanding the system's strengths and weaknesses and being able to adapt to those changing market conditions, those are crucial.
Okay.
It's what they refer to as the care and feeding of a turtle system.
The care and feeding, I love that.
You need to constantly monitor its performance, adjust your position sizing based on your risk tolerance and your account balance, and even modify the system's parameters if market dynamics change significantly.
Okay, so you really have to stay engaged.
You got to stay engaged, yeah.
Okay, this has been so fascinating, but I think we need to take another break here to absorb all of this valuable information.
Yeah, there's a lot here.
There is. We'll be right back to finish up our deep dive into Inside Advantage. Don't go away. We're back.
And, we've been digging up some really great stuff from these Inside Advantage newsletters.
It really is incredible, just how much practical wisdom is in these pages.
I know. I mean, from seasonal patterns and intermarket analysis
Or even psychology.
to the minds of these legendary traders.
Yeah.
I mean, it's like it's a real treasure trove,
Yeah,
of market knowledge.
it is.
And we keep coming back to this idea of money management, which Inside Advantage really seems to argue is the most important part of trading success.
It's the foundation,
Yeah.
that everything else is built on. Without it, even the most brilliant trading strategy is going to fail eventually. And they really emphasize protecting your capital,
Managing risks.
staying in the game
Yeah.
long enough.
To let those winners compound.
Right. And I like how they offer some compelling alternatives to like the traditional fixed percentage risk management.
Yeah.
You know, we talked about the fixed ratio method,
Yeah.
where you adjust your position size
Right.
based on your account balance.
And the system's historical drawdown.
Right.
That can be a lot more effective than just using a fixed percentage.
I think so too. I mean, it's about finding that sweet spot
Right.
between maximizing your profits
Maximizing profits.
and minimizing your losses.
Minimizing losses
Mhm.
without, being too greedy,
Right.
but also, not cutting your winners short.
It's a balancing act.
It is. Requires
Right.
a real understanding of, your risk tolerance,
Yeah.
market dynamics.
And the historical performance of your system.
You really got to know your system inside and out. And Inside Advantage also really stresses having a clear exit strategy for both your winners and your losers.
I know that seems obvious, but
A lot of traders don't plan for their exits.
bad.
They get caught up in the excitement of a winning trade and hold on too long.
Right. Of course.
Or, their emotions take over during a losing trade
Mm-hmm.
and they fail to cut their losses.
I can see that happening, yeah.
You got to know when to take profits and cut your losses.
Yeah.
It's essential for preserving your capital and avoiding those emotionally charged decisions.
Right, which often lead to mistakes.
Big mistakes.
So it's about having a plan,
And sticking to it.
even when the market is, doing crazy things.
Absolutely. Discipline and emotional control, those are essential for success.
Yeah, those are good words to live by, I think, in trading. I mean, one of my biggest takeaways from this whole deep dive is that successful trading isn't just about, finding this magic system,
Right.
that always works. It's more about, a holistic approach
Right.
that takes into account, market analysis,
Risk management.
trading psychology.
Yeah. And knowing your strengths and weaknesses as a trader.
It's about approaching trading as a profession, a craft
Yeah.
that requires constant learning, adaptation, and a relentless pursuit of excellence. You're constantly learning and refining your approach.
You never stop learning. And it sounds like having a real passion for the markets is important.
Yeah, you gotta have that passion. You gotta be curious about how the markets work and be willing to put in the time and effort.
I mean, that's what keeps you going.
When things get tough, and believe me, they will get tough. Every trader faces challenges and setbacks. But, having that passion will help you persevere.
I think so too. Inside Advantage, I think, does a great job of conveying all of these principles.
Yeah.
And I really hope that our listeners have found this deep dive as insightful as we have.
I really think anybody who takes these lessons to heart can improve their trading results and increase their chances of success in the long run. It's not about getting rich quick. It's about consistent, disciplined execution. Yeah, slow and steady wins the race. So what does this all mean for you, the listener? What can you actually take away from this deep dive into Inside Advantage and apply to your own trading journey?
Remember the power of seasonal patterns and those intermarket relationships.
But don't just blindly follow historical data.
Right.
Always look for the why.
Ask yourself, why is this happening?
Why?
Don't be afraid to question conventional wisdom. The markets are constantly evolving, so what worked in the past might not work today.
You have to be adaptable. Develop a trading style that aligns with your own personality, your risk tolerance. Find a system that you can execute consistently,
Even when you're under pressure.
even when things are crazy. Money management.
It's key.
It's key. Protect your capital, manage your risks, stay in the game long enough to let those winning trades compound.
And most importantly, enjoy the journey. Trading is a continuous process of learning and growth. Enjoy the challenges, celebrate those victories, and never stop striving for excellence.
Couldn't have said it better myself. That's it for today's deep dive into the world of trading and market analysis. We hope you've gained some valuable insights to help you on your own trading journey.
Happy trading!
Happy trading, everybody, and we'll see you next time on the deep dive.